India just made a major move to attract foreign capital. The government has removed capital gains tax and interest income tax on eligible investments by foreign investors in Indian government securities. Now, why does this matter? Because investors care about what they keep after taxes. Let's take a simple example. Suppose a foreign fund invests rupees 1000 crore in Indian government bonds yielding 7%. Now that generates 70 crore in annual interest income. Earlier, with a 20% withholding tax, the investor would lose around 14 crores and keep only 56 crore. Now, the investor keeps the full 70 crore. That's a 25% increase in net income without taking any additional risk. Now, that's why the markets reacted immediately. The rupee strengthened from around 95.67 to below 95 against the dollar after the announcement. Because if Indian bonds become more attractive, foreign investors may bring more dollars into India. More dollars entering the country means greater demand for the rupee. But the bigger question isn't today's currency move. It's whether this impacts Indian markets. Potentially, yes. If foreign investors buy more government bonds, bond yields can fall. Lower yields can reduce borrowing costs across the economy. That benefits sectors that rely heavily on financing, including banks, NBFCs, infrastructure, and real estate. A stronger rupee can also help reduce imported inflation, especially from crude oil. And lower inflation gives the RBI more flexibility on interest rates. Now, this policy is aimed directly at the bond market, not the stock market. But if it attracts sustained foreign capital, the effects can eventually flow into the broader economy and financial markets. So don't just watch the rupee, watch the foreign bond inflows and government bond yields, because that's where we'll find out whether this was simply a tax change or the beginning of a larger capital cycle for India.